Well, good morning and welcome everyone to our first ever real estate investor story time. I'm super excited about doing these. We've not, good morning. We've not really done these before, but if you have any questions throughout, please do use the chat. I am going to kind of monitor those and answer any questions you have. But this is intended to be like an entertaining, sort of like story-based, education-based sort of thing going on. So what I'm going to do today is I'm going to tell you the story. First of all, I'm James Orr. I'm a real estate broker in Northern Colorado. And what I'm going to do today is tell you the story of Andrea. So Andrea is a recently divorced woman. She's got two small kids, ages 2 and 4. A gentleman never asks how old she is, but between you and me, she's 40 years old. And we're going to talk about her situation and kind of like the plan she's put in place. And by the way, this is fictitious, but it's educational and instructive to do this stuff. So this is not a real person. It's kind of a typical person. And so we're going to kind of like walk through what's going on in Andrea's life, how it's all working out, and how the situation may unfold. And provided this goes well, we'll probably do updates to Andrea's story over time. So as the market actually progresses and she implements her plan, we'll come back and revisit Andrea and say, this is actually what really happened to her and what could look like in the future, and what are some things we could do in order to change stuff. So we have some people kind of rolling in a couple minutes late. That's totally fine. If you would, please do address all panelists and attendees if you've got questions in the chat window, and I'm happy to address things as we go. So I'm just going to start telling the story of Andrea, and we're going to walk through, and I'm just going to kind of give you some insight as to like what's going on in her world, how things are working out for her, what her plan is, and how she plans on kind of like living her life. So I created a scenario in Real Estate Financial Planner. That's where we're getting these numbers from today. And so as I mentioned before, Andrea is a middle-aged, recently divorced woman with two small boys, aged 2 and 4. She went to Arizona State University and she studied hard there, was a really good student, and got her degree in accounting. She has a great job. She works for a small manufacturing company in the accounting department, doing miscellaneous accounting type things, which is all mystery to me. And she loves her coworkers, loves her job. It pays relatively well. I mean, she makes about $4,000 a month gross, and she's concerned, being a recently divorced woman with two small kids, that her income is not going to be enough to both fund her retirement and also give her two kids the lifestyle that they deserve. And so she's highly concerned about being able to have enough money to provide for her kids and also be able to save for retirement. Her ex-husband, not really a nice guy at all, kind of a jerk between you and me. So she stayed in the relationship probably a little bit too long. But they did have, because they were both working at the time, they did have a little bit of money saved up. They did have a common house, which they liquidated for the divorce. And she ended up walking away from the divorce with about $100,000. Between the appreciation we've seen in the recent years and a little bit of retirement income that she got part of, she got paid out for as her share of the divorce proceedings. She's starting with $100,000. And one of her concerns was, after talking to some of her friends, was, don't make any rash decisions. I mean, we just had a major life-changing event, and, you don't want to do something rash and jump into something. So one of the things she was considering, she'd kind of, been online, stalking some of the discussion forums and reading about real estate investing. And she thought, the market I'm in, the houses are about $250K. And I could, with this $100,000, I could go and make my money go and maybe buy 2 rental properties with 20% down. You need about $50,000 in order to do that. And so she's considered that. She's like, maybe I should go buy 2 rental properties. But, her friends convinced her, why don't we slow down a little bit? Had a lot of changes going on. Things are going to be up and down a little bit next, 6 months, a year, whatever it's going to take. And so rather than making a rash decision, she decided she was going to talk to a real estate agent and lender friend of hers. And she determined that she's going to buy a house to live in with the two kids, the 2-year-old and the 4-year-old. And so she goes and she decides she's going to put 5% down and buy one of these houses. And so let's just take a look at what the numbers look like, the assumptions we use, and what the numbers look like on the house. And so I'll go ahead and pull that up right now. And so I'll kind of walk you through some of these numbers. You guys are going to, for the call here, you guys are going to see some things that are very new, things that I have not yet presented before ever. We're going to go do a whole class on some of the things I'm going to discuss here in a little bit. So realize if you want me to reteach that class, it's probably not going to happen this morning, but I will go ahead and teach a full 2-hour class on some of the things you're going to get to here. So she just goes and she talks to her friend in the mortgage business, and she talks to a real estate agent, and she finds some property. The average price of the house that she's looking at are about $250,000. She's able to get a quote for about 3.125% from her mortgage broker friend. Interest rates are near all-time lows right now. And so she's able to get a really good interest rate on that for a 30-year mortgage. That's putting 5% down. Now, she's going to have PMI. She's going to have private mortgage insurance. Anytime you put less than 20% down to buy an investment property, you're going to have private mortgage insurance, which is special insurance that the lender, a third-party company, is going to charge you to protect the lender in case she defaults on the loan. If she had put 20% down, she wouldn't have to pay this PMI. But in this case, because she's opting to put 5% down, she's going to have a little bit of private mortgage insurance. And she's going to buy this property. She's going to move in. And the yearly private mortgage insurance rate is 0.8% of the balance of the loan. And so the PMI payment is going to be $158 and change per month when you do that. And it does drop off. This is not an FHA loan. It does drop off after she gets to about 80% loan to value based on her property value. And so in our modeling, it does drop off with that too. We assume that she has about 1% in closing costs if she's going to buy this property. And she's not getting any seller concessions. We just did some calculations for the depreciation, how we're going to calculate all that. But while she's living in it, she doesn't get depreciation. Again, we said she started with this $100,000. That's the proceeds that she had from her divorce. And we're assuming that property values in her market are starting at appreciation of 2%. But in our modeling, we really don't know what the market's going to do. The market could go up much higher than 2% per year. The market could go down. We could see a decline in value. And so what we did for this model, which is highly unusual compared to some of the other things we've done in other classes, is we've decided to model this with a random appreciation rate. So if we ran this scenario again, the results would be slightly different. So I'll show you that here in a minute, but we decided, hey, listen, appreciation can be random. One house could appreciate a little bit more than another. And we also did rent as rent appreciation as random as well. And GNS, I thought for, I think she means, or he means PMI to drop off, one has to refi. And that is true with FHA loans. So with FHA loans, PMI has to your loan has to be refinanced in order for you to get rid of PMI. With conventional financing, which is what we're talking about Andrea using here, she's putting 5% down, and that does not need to be refinanced in order for it to drop off. It drops off automatically based on loan to value. And in some cases, if you want to use some of the appreciation, the property value going up in order to get rid of the PMI, the lender may require you to do either a desktop appraisal or have a full appraisal done. In many cases, they will be able to do their automatic valuation model and have it drop off when your loan to value drops below 80%. So yeah, you're very, very welcome. And the other question was, how come there's no depreciation for the first year? So depreciation, the tax benefits of owning a rental property, only apply when you have a rental. So Andrea is going to be moving into this property and living there for the first year. And so in this case, she doesn't get the depreciation benefit in the first year. It's not something the IRS tax code provides to her. So that's the reason why she doesn't get it. But as soon as she converts it to a rental, she does start collecting depreciation benefits. And so we'll talk about that a little bit too. So we talked about the appreciation rate. We really don't know what the property values are going to be doing. And as a side, if anyone else has questions, please do feel free to use the chat window. I'm happy to answer questions and kind of explain what's going on in Andrea's story. But I think this is sort of like a It's a new style for us. We're trying the story-based education model where we're just telling Andrea's story and what's going on in her world and why she's feeling this way and her concerns. And then we're rolling in the education part of the real estate investing stuff. So hopefully you guys enjoy this, because we'll do more of them if you do. So eventually, this property, $250,000 property, should get about $1,600 a month in rent. And so when she's out there, she's considering this. Hey, I'm recently divorced. I've got these two small kids. Should I rent or should I buy? And she has some money to be able to buy. She has got that $100,000. And so she decides, hey, listen, it's going to be really close. It's going to cost me about $1,600 a month if I decide to rent, or I can buy a house and my mortgage payment and taxes and insurance and all that other stuff is going to be very similar to that. And I'll show you the math for that in a second. Rent depreciation, we're assuming rent's going up around 3%. But again, this is also that random number. And I'll go through the details of that here in a little bit. But we're just assuming that to start with. We're assuming 3% vacancy because she's going to manage her properties pretty well when she does that. Here's your taxes and insurance estimates. And in this case, there's no HOA in the property. We're assuming that when the tenant lives in the property, they're paying all the utilities. While she's living in it, it's coming out of her own personal expenses. We're also setting aside 10% for maintenance on the property. So she's setting aside money to do that, and she's managing the property herself. Okay, so return in dollars. So this is stuff that many of you have seen before. This is my return on investment quadrant type stuff. And you can see in this particular case, if she were to buy this property and she had a 2% appreciation rate in the first year, she would make about $5,000 on that $250,000 property. So the property, a $250,000 property going up 2% would make about $5,000 in appreciation. So the appreciation part of the quadrant, these are the 4 different return areas when you own property. And so she would make about $5,000. If she were renting it in year 1, and she's not, she's going to be moving in. If she were to rent it in year 1, her total cash flow for the year would be about $28. So really, she's not getting any significant cash flow. This is about a break-even property, putting 5% down with PMI. So it's about break even. It's about $28 if she were going to rent it. She's not, though. And her tax benefits, basically, if you were able to rent it out and she was going to take that depreciation benefit, this is the depreciation amount. So if you remember how depreciation works, you take the value of the property, you take out the value of the land because we cannot depreciate land. And so you have the value of the building left over. You take the value of the building and you divide that by 27 and a half years. And that gives you the amount of gross depreciation you could take each year on that property for 27 and a half years. And then if you take that gross depreciation you're getting for the year and you multiply it by technically your highest tax bracket because it comes off the top, but in this case, we're going to use effective tax rate, then you figure out what the amount you're saving on your taxes are. And in this case, she's paying about $1,159 less in taxes each year by owning this as an investment property. And if you think about it really hard, squint and call that $1,200, it really looks like she's getting an extra $100 in cash flow per month because of the tax benefits she gets from depreciation. So if you think about it that way, that's how it looks. And then finally, paying down on her loan in the first year, she's going to pay down $4,856 in principal. So that's how much money she has made from debt pay down, appreciation, cash flow, and tax benefits. So the total amount of money, their total benefit, her total return she's going to get is $11,043 if she were going to rent that in the first year. Okay. Now, if we say she's going to make $11,000 in her first year, she bought this and converted it to a rental, and we divide it by how much she invested in order to get this property, her down payment, closing costs, any rent-ready costs, anything like that, minus any seller concession she has, we can determine what the percentage return she's seeing on that money is. And so in this case, she made $5,000 in appreciation. She invested that 5% down payment and some closing costs. And so her return on the money she invested is about 33% from appreciation, the property value going up. Her cash flow return, because she only made $28 for the entire year, very, very small, 0.19%, very small amount in cash flow return. The tax benefits, she's doing about 7.73% return on her initial investment from those tax benefits. And then the debt paydown return, she's making a 32.37% return on her money, on her initial investment and closing costs and everything else, from that amount that she's paying down the loan. So if you think about it, she's a pretty smart cookie. She has her accounting degree, And she starts thinking to herself, I have this $100,000 and I'm going to invest that in the stock market while I'm waiting to do anything with it. But let me take a small piece of it and let me go and invest it in this property. And what kind of returns am I likely to get if I go do that? Now, none of this is guaranteed. I mean, a year from now, we'll know what the actual appreciation was, what the actual cash flow was, what the actual tax benefits are pretty much fixed because it's based on the purchase price. Debt pay down is pretty fixed unless you pay extra on your mortgage. So of those, though, she says, hey, listen, I could get a 73% return on this very small piece. I'm going to take and invest it. And one of the things I think about doing is improving my returns on some of my money. And maybe we're going to repeat this over time by buying additional properties and doing this. But she starts thinking that's a pretty good return. Now, I'm not going to cover return on equity because it's beyond the scope of what we're talking about here. But this, instead of dividing by your initial investment, return on equity would allow you to calculate what return you're getting on the equity you have in your property. So as your property debt pays down, as the property value goes up, the amount of equity you have increases. And so we would think about that. What is the return I'm getting each year on that equity amount? And this does that calculation for you. Now, this is the preview of what your guys are going to see in October. So this is a little bit of an early preview of it. But these returns include calculating in if she kept 6 months of reserves, 6 months of principal, interest, taxes, insurance, HOA, PMI, all of those things. If she says, okay, I'm going to set aside 6 months of this money in reserves elsewhere, how does my return look if I say, okay, my return divided by my initial investment plus this 6 months of reserves? And there's some complications to it. There's a lot of nuance to it. But this then goes and shows you what that new return is. So instead of her getting the 73% per year, now when you calculate in the drag from her reserves, it's a 45% return on her money from doing that. Okay, so I'm gonna jump back up to the top here and show you what's going on with this. So this is the cash flow power meter. Some of you guys may have seen classes on this. So when we look at this property, she has just about break-even cash flow. Okay, she's got her cash flow from depreciation. This is the amount of debt pay down she's getting. This is the amount of cash flow she'd have if she had full property management. But she's basically break-even cash flow with just 5% down doing this. And so that's the type of property she's doing here. So Andrea's really concerned because she wants to be able to provide for her kids, have her kids do all the fun things that they need to do, summer camps and after school activities, and, be ready to have, things that they need in their life to have a good lifestyle. And so she's not willing, in this particular case, to take money away from her income. She earns about $4,000 a month, and she's not willing to take money away from providing that good lifestyle for her kids in order to save for retirement. So really what she's thinking is, hey, listen, I'm going to try to make do living on my income, but I'm going to use the money, the proceeds from the divorce, in order to invest and try to do it that way. So let's take a look at some of the things that have happened to her. All right, so for those of you that have never used this before, if you click on Blueprint, Blueprint allows you to see significant events. GN says, does the concept work in higher price markets for owner occupant? And the answer is you have to run the numbers to see, but probably yes. It may not work exactly like this. Your numbers will likely be different, but there's lots of variation. This is one of the reasons why we're going to do all these stories. We'll pick higher price markets. We'll pick lower price markets. We'll pick markets that have better cash flow than this, or markets that have worse cash flow. Markets where appreciation is higher, markets where appreciation is not as high. And so we'll do a lot of variations like this over time with different stories. But yes, it probably does work, but the numbers are going to be different. It's not going to be the same. For example, if you pick higher price markets, you will have a higher net worth at the end because you're buying higher price properties. So yeah. So let's get back to Andrew's story. So the Blueprint kind of selects significant events in the scenario that you're running. And so we're going to just walk through some of the different significant events, buying different houses, what it looks like, and then her achieving financial independence and what that looks like. So first month, she goes, after being recently divorced, she goes and she buys a house. She puts 5% down. So she started with $100,000. Her account balance at the end of doing that is about $84,854.71. Her buying the property was a $250,000 property. She put 5% down. So her down payment was about $12,500, and her closing costs were about $2,500. Her total cost to close about $1,500. So really simple first year. She buys a property. She moves in with kids. She lives there for a year. So at the end of that first month, she basically owns one property. Her net worth is about $97,000 in high change. And like, James, I thought she started with $100,000. How come her net worth isn't more? She had some closing costs. So she had some money coming in from the money being invested in the stock market, but she had some closing costs. So her net worth actually went down a little bit. We assumed there was no appreciation on the property. And she had $84,000 in change in her bank account. The rest of it was in equity in the property. And so you can see that. And she's making that $4,000 a month in her income. Her tax rate, let's see, I think her tax rate is, I think it's like 19 point something percent. So she's seeing paychecks after tax of about $3,200. She has about almost $2,000 in personal expenses. And after she pays her other stuff, she's going to have almost $0 left over when she calculates in from her mortgage payment. Why are the squares sideways? Oh, you mean the numbers? Oh, because we could show these as columns later. They're going to add. They're going to have multiple ones. If you're talking about why the numbers are sideways, Susan. And this calculates what her minimum income required. So this just shows you her account balance over time. So when she bought her first property, she had about $84,000. Stock market's going up and down. Sometimes she makes money that month. Sometimes she loses money. It's all random based on actual historical stock market data. And then by month 12, she takes her another down payment and she buys a second house. And so her account balance drops down. And she's okay with this, right? She realizes, hey, listen, I just went through a pretty significant life change. I want to have big cash reserves. I want to have a lot of money in the bank because I don't want to make any rash decisions and spend all my money. So she decides, I'm just going to invest some of this in the stock market and I'm going to take the rest of it and I'm going to buy one house. And then in year number 2, she buys a second house. And so here's what she decides to do. She's like, hey, I got this house. I'm going to convert the one I was living into to a rental property. I'm going to start renting that out. And I'm going to go buy another house with 5% down. I'm going to move into that one as an owner occupant, and I'm going to live there for a year. So that's what she decides to do here. She just bought the second property. Her account balance now dropped to $77,000. The down payment is now $12,750. Closing costs a little bit more. Her total cost of close was $15,300. So the property values went up the tiniest bit over that year. Okay. So now she has lived in that property. She's moved into it. She now owns 2 properties. Her net worth has increased over time. It dropped a little bit when she bought the property. So it's $112,000 is her net worth at this point. Her total account balance dropped down from $92,000 and change to $77,000. This is the amount in her bank account. And her total cash flow, including depreciation, is about $153 per month, $154 per month. So that first property she bought happened to do well that year. And rents went up a little bit. And so she's collecting about $150 per month, including the tax benefits. Before we talked about it was only $28 per year in cash flow on the property, but there was like $100 per month in cash flow from the depreciation, the tax benefits. And so now she's saying the real numbers worked out to be about $154 per month. This is what her paycheck is. She's getting little raises over time, so her paycheck's going to continue to increase. Basically, it's keeping pace with inflation is another way of thinking about that. And she's continued to do that. She's basically saving no money from her paycheck each month. She's spending it all on the kids. She wants to make sure that her kids are well taken care of, that they can do the things in life that they want to do, that they have summer camp, after school activities, that she can go out to eat every once in a while. She can take a vacation with them. So she's really concerned. She's a planner, by the way. I mean, she's a accounting background. She's thinking about things. She's like being deliberate in how she's spending her money. And she's good with her budgeting. And she's definitely got her background in accounting and can budget. And so she's living within her means. She's not dipping into her savings or investments, but she is living on her full paycheck. And then account balance shows you that you bought this first property, and then we're going to buy another property in month 25. So she bought a property, she lived there, account balance went up. She bought another property, converted the previous one to a rental, and now this is her third property that she's buying, and her account balance drops down to $70,000. Her down payment amount she needed is $13,226.01 and $15,606. So one of the questions that comes up on here is, Doesn't she need to be making more money to support these properties? And the answer is probably. And the reason it is probably is because you can count the income you're getting on the properties you're renting out to help cover that debt load. But you do need to have enough income coming in to cover any negative cash flow you might have based on how the lender does calculations. And so this table shows you how much minimum gross monthly income you would need to be making in order to be able to qualify for the loans with a 45% debt to income ratio. So in order for her to qualify for that other property, she would have needed to be making about $3,000 a month total. And Susan says, you can only count 75% of rents. Yep, that's correct. That's how the lenders typically do it. They will count 75% of the rents coming in order to cover your expenses on the property. Okay, so that's what she's done. So at the end of month 25, she's now bought 3 properties. She had one from very first month. She bought a second one in month 13 and now bought another one in month 25. She has 3 properties. 2 of them are rentals. 1 of them she's living in. Her net worth, about $137,000. She started with $100K. Total monthly rents coming in, this is gross rents, is $3,350. So the rents are whatever that is, $1,700 almost a month for rents. So here you go, $1,652 for rent and $1,697. So that's what she's able to get for rents on the 2 different properties. So one property did a little better than another. One property's rent went up a little faster than the other, or it had a little bit better rent to price ratio. So her cash flow on the properties, not including the depreciation benefit, the tax benefits, she's making about $60 a month on one, and she's making about negative $26 a month on the other. So she has some negative cash flow. If she had put 20% down, she probably would have had positive cash flow. She didn't. She put 5% down. And she has PMI, private mortgage insurance. Okay. So in this case, she's got a little bit of positive cash flow from one, a little bit of negative cash flow from the other. Here's her total account balance, and it shows that it went down when she bought that next property. Total amount of equity in the properties, it's about $66,000, almost $67,000. And the total cash flow, when we take into account depreciation, the tax benefits as well, she's making about $230 a month between both properties, including the tax benefits of depreciation. Her gross paychecks, that's what she's doing. She's making a little bit more each month. We'll skip some of those for the sake of story continuity. In this case, she needs to be making a little over $3,000 a month in order to be able to qualify for buying this property. And then she goes and she buys her 4th property. So this is the first property she owned, her second property, her third property, and now this is in month 37. She goes and she puts 5% down and she buys another property. So each year she evaluates this and she says, does it make sense for me to continue with this plan? Should I continue buying another property at this point? And she does the math. She says, look, I can either have this money and stop and keep this money invested in the stock market and just let these current properties that I own do their thing, live in this property that I'm living in, or does it make sense for me to put 5% down, buy another property, move into it, live there, convert the last one to a rental so that I have more rentals? Because as we showed before, the return she's getting on these rental properties is probably a lot better than she's likely to get in the stock market. Even when you take into account reserves and some negative cash flow in some cases, it's still much better. Okay, so she goes, she buys property. This is how much she needed for a down payment. Again, she's putting 5% down, moving in as an owner occupant, and this is what her closing costs were. And so this is it. And as an aside, I did model in this different interest rates. I want to show you that because I think interest rates right now are ridiculously low. And the chance of Andrea being able to get the same 3.125 interest rate forever is not likely. She may be able to do it, but it's not likely. So I'll show you what we ended up doing. Interest rates were variable. They were going up over time or going down because we don't really know what they're going to do. They could go back down to this low again, but we don't really know about that. So I'm going to look at mortgage interest rates. I'll show you what they were. So these are the different interest rates she was able to get in her properties. So the first property she got, she was able to get 3%. Okay, that's what the interest rate was when she bought her property. On her second property, 3.75. That was a year later. On the third property, 3.25. That was 2 years later. Fourth property, 3%. The fifth property, 3.25. 3.75 on the sixth property. Oops. 3.625 on that seventh. 3.625 on the eighth. And 3.375 on the ninth. If we ran this scenario again, and we could set the range of what we want the interest rates to be. If we decided to run this again, though, the interest rates would be different. And so Susan clarifies. So she is moving every year. And that's correct. She decides, instead of just taking the money and investing in 20% down rentals, that it's more advantageous for her to acquire a larger asset base, and she's willing to deal with the inconvenience of moving to do that. There are some strategies where she could have done some things like structuring creative financing or going off market, where she could have taken over, creative financing type debt or something like that. But that's not her. I mean, she's an accountant. She's not willing to do that. So there are other options for other people, but it was not an option she was willing to do. She really wanted to focus in on taking care of herself, taking care of her kids, and being very methodical about her investing over a long period of time. And she's willing to do, she's a hustler. I mean, she's willing to go work and put in the effort. And so she's willing to move. Okay. So we just covered this. This is her buying that property in month 37. I'm going to skip over the summary here for a little bit. Some of her rents. So the three properties she has rented, she's living in the fourth. $16.57 in rent, $16.27, and $17.48. That's what she's getting in rents on those. The cash flow, she's getting about $60 a month positive cash flow on one, about negative $90 on the other. So rents went down that year on that one, and the $56 on the third one. So she's got two with positive cash flow and one with negative. If you take into account the cash flow with depreciation, her aggregate between all the properties, the three properties she owns, is about $321.35. So you take into account the cash flow plus the cash flow from depreciation, she's about $321.35 per month positive when you take into account tax benefits. This is her paycheck stuff. We'll skip that for now. She's really not saving any money. She's spending it all on the kids. No, the properties have their own money coming in, but she's spending her full income from her job on her kids. So she is not saving any money there. This is how much money is required for her to qualify for these loans. Looks like it peaked at about $3,156, so a little less than $3,200 a month. Remember, she's making $4,000. And realize too that this dollar amount, the $4,000 was in month one. She's getting little raises over time, and so she's doing that. And Susan says, so the properties are never empty. Yep, she's basically renting them out during the period of time when she's starting to shop for the property and saying, okay, I got the property I want. Let me get this one rented in the next month. And so that she moves out of the property and she has her tenant go in right away. Now, in the modeling, when you buy a new property as an owner occupant, you don't have a mortgage payment the first month because mortgages are paid in arrears. So when she moves into her property, let's say she moves in October 1st, the October 1st through the October 31st period, there is no mortgage payment due. Her first mortgage payment is due November 1st, and that covers the interest that accrued during October. So that is correct. And Susan says, so the properties are never empty. Susan, and I'm assuming that doesn't sound right, is in reference to the properties are never empty. There is also a vacancy allowance. I think we're using 3% for vacancy as well. So I'm not sure if you're saying that doesn't sound right to that, or maybe you're saying that doesn't sound right to something else. Happy to discuss with you whatever you want to talk about. Vacancy. Yep, vacancy is that way. And yep, I have clients do this all the time. They rent out their property because it's a requirement for them to get their loan. So we fill the properties while they're under contract to buy the property because we have to provide a copy of the lease. So not sure what to tell you, but I do it all the time with clients. So that's that. And then when they buy their next property, so this is the first property, this is their second property, this is the third, this is the fourth, and now they bought their fifth property. Again, they're moving in and they're living in the property, and then they're converting the other one to rentals. So now they've got 4 rentals and 1 property they're living in. This is the amount they needed for down payment. This is the amount they needed for closing costs. This is the total amount for closing. And this is at the end of the month. So now they own 5 properties. Their net worth is about $223,000. So Andrea's increased her net worth by more than twice when she's done this. This is the total amount of gross monthly rents coming in, just under $7,000. And here are the rents of the properties: $1,687, $1,705, $1,725, and $1,800. So she is managing these properties, doing this. Here's the cash flow. Positive on the first one, slightly negative on the second and third, and positive on the fourth property. Just so happened that that one had better price to rent ratio. Total account balances, you can see that her account has dropped now to $56,000. She's been using this money to do down payments. And if she has negative cash flow, that also comes out of there. But the properties, she also has this money invested in the stock market waiting for it to be deployed in rentals. Total equity in the properties is about $167,000. Her total cash flow, including the tax benefits, is about $593 per month at this point. So she's getting to the point where her cash flow on her properties is increasing. It's getting to be pretty significant, over $500 a month. And let's see here. Now, because the cash flow on the properties that she already has is increased, the amount she needs to be making from her job is actually going down overall. So the high was back here, almost $3,200. Now she only needs to make just over $3,000 in order to be able to qualify for the same loans. And now she goes and she buys another property. This happens in month 61. She does another model, which is at $13,000. So she needed about 16 in high change in order to be able to close, including closing costs. Same idea. You can see the cash flow on the properties, just buying more properties each time. And I'm going to skip ahead to show you what happens at the end. So I believe in month 97, let's double check this. Oops. So Andrea, in this particular case, by moving into properties, living there for a year and converting them to rentals, what we call the nomad strategy, is able to achieve financial independence in 211 months. Now I want to talk about this a little bit. And Susan says, doesn't the lender stop lending after so many properties? And that is true if you are buying properties as an investor and you're putting 20% down. You are limited to 10 properties for Fannie Mae, Freddie Mac type loans. However, if you're buying owner-occupant properties, which is what we're doing in this case, we're buying a property, moving into them, and living in them for a year, there is no limit from Fannie Mae, Freddie Mac as to how many properties you can do. You can always buy another owner-occupant property. So technically, no, she does need to be able to qualify for them, which is what that income calculation was all about. So no, that wasn't the case. But here's how I want to think about this. So this is one of the things that Andrea was thinking about. She's thinking to herself, okay, I've heard about this idea of the 4% safe withdrawal rate. And what the 4% safe withdrawal rate talks about is it was a study done by 3 professors from Trinity University. And they went and they back tested a bunch of data on how much of a retirement portfolio can you safely take out and live off of, can you spend and not likely run out of money in your retirement. And so they went and they did a whole bunch of math on this. And what they determined is for a retiree to live 30 years, assuming certain percentage invested in stocks, certain percentage invested in bonds, that you could take out reasonably 4% of your initial balance per year and not likely to run out of money for that 30-year period. There's a whole bunch of caveats to that, and I do other classes where I talk about this in excruciating detail and why there's some problems with it and everything. It's much more conservative to use a lower number, but she doesn't know all this, okay? So she says, I went and I did some online research, and I've seen it on the discussion forums, and I've seen people discussing this 4% rule, and so that is a more aggressive version of it, and so let's use the more aggressive version because I think it's appropriate for her to think in terms of aggressiveness to kind of compare these two. And so she says to herself, okay, I've got $100,000. If I don't do anything else and I have $100,000, I can safely take out 4% of that amount of money each year and live off that without touching my, without having problems with retirement later on. And so 4% of $100,000 is $4,000. Can she live off of $4,000 per year? The answer is no. But the good news is she didn't plan on retiring at age 40. She planned on retiring 10, 20, 30 years down the road. And so she starts thinking to herself, okay, if the stock market, she learned this in her accounting school, if the stock market is earning 7.2% per year, which is an arbitrary number, but it makes the math easier for doing what I'm about to do. Using the rule of 72, that means my money would double every 2 years. I'm sorry, every 10 years. So you use 72 at 7.2% per year. The rule 72 at 7.2% per year means your money doubles every 10 years. So at 10 years from now, when she's age 50, she'll have $200,000 invested if the stock market earns 7.2% a year. What is 4% safe withdrawal rate of that 200K? That's $8,000 a year. That's not enough for her to retire. What if we go out another 10 years? So this is 20 years from now. Her money would double again. So it went from 100 to 200, it doubled. Now it's going to go from 200 to 400. So at 400,000, 20 years in the future, what is 4% of the 200,000? If my math is right, it's $8,000 a year. That is not enough for her to live on. So what if she goes out another 10 years? So 30 years into the future, she'd be 70 years old. She went out that far in the future, then her money would double again. It would now go from, it went from 100 to 200, that's one doubling, 200 to 400, that's another doubling, 400 to 800, that's another doubling. So she has 800,000 at 4%. If my math is right, let me just do it. 800,000 times 0.04. So that's $32,000 a year. Now that's in today's dollars. So realize that her living expenses, because of inflation, have gone up. And our math does take into account inflation when we calculate the amount of money she needs for retirement. But that's probably still not enough. So she wouldn't, if she just invested in the stock market with this 100,000 and she didn't save any money from her job and add to that, she probably would not have enough money to retire. Okay, she would be short. So when we do this model, though, what we do is we take into account any cash she has in her stock market account, and we use the 4% safe withdrawal rate for that rule, plus any cash flow, net cash flow she has from her properties after all expenses, principal, interest, taxes, insurance, maintenance, property management, if she's doing that, all those expenses on the property. Okay, my wife just told me that the guy's here to do work on her house. So basically, if she has all this money saved up, all of that, all the expenses on that, any net cash flow she has, that also contributes toward her retirement. So when does she get to the point where the cash flow from the rental properties and any money she has in the stock market gets to the point where she's able to retire? And it's where this red line crosses the dotted red line. So right about here, which is 211 months from now, or 17 years and 7 months. So when she's 57 years old, when the kids are probably in college. So she'll be able to spend all the money she has on her kids from her income, as long as she's willing to work hard, move every year, convert these to rentals, manage the rental properties, manage her assets. She'll be able to have enough money to retire with that $4,000 a month coming in. Now from passive income, she could stop working at that point and live forever. And in fact, you could see she actually will be able to increase her lifestyle over time because the rentals over time, the cash flow on them is increasing. Eventually the loans get paid off and her cash flow increases significantly more and she's able to live a much higher lifestyle. So let me show you the last year. This is kind of the summary. So in the last year, let's see here. Where is cash flow? Well, why don't we just do it this way? All right, so let's take a look at cash flow on these properties. So cash flow. So this shows you the cash flow on the properties. I'll just take a look at one to start with. Let's take a look at the first one she bought. So when she bought this property for the first one, While she lived in it, she had negative cash flow. She was supporting all of the property expenses. Then cash flow started off really, really small. And over time, some years rent went up, some years rent didn't go up. Rent went down here. And rents kind of increase and decrease over time. And eventually she gets to the point where the property gets paid off and cash flow significantly improves. Now, this is in non-inflation adjusted dollars. This is in dollars that are getting bigger over time. If we adjust back to today's dollars, it is like her getting about $1,200, give or take a little bit, per month in cash flow from that one property. So really, how many does she need paid off properties to live that same $4,000 a month lifestyle she's been living today? Well, 4. And that'll be a little bit conservative. I got a couple questions here, so I'm going to get to this. So is that applicable for house hacking multi-units? GNS, is that applicable to house hacking multi-units? No, this is less aggressive than house hacking multi-units. If she were to go and buy a duplex or a triplex or a fourplex and do some house hacking, or she was willing to have her girlfriend or close male friend and they were willing to be roommates and she had a little bit of extra income from that, it would improve on these numbers. In this case, she wasn't willing to do that. She's like, look, it was a rough couple of years. I'm divorced. I need space. I need mental space to focus on my kids. My financial situation isn't such that I need to get a roommate. Could I go buy a duplex or a triplex or a fourplex for the first property? Sure, totally could. If you could find one and it made sense to do so. Absolutely could. It would change the type of financing. It'd be FHA financing. She's not a veteran, so she can't get VA. Because in order to do the multifamily, you're going to have to do an FHA loan or a VA loan in order to do that. So it would change the financing type. PMI would not roll off ever if you got an FHA loan. That's the current status of those. But could she go and do that? Yes. Could she go and do duplexes for like the next 8 properties? No, she could not. Okay. FHA loans, there are some unusual exceptions, but in the overwhelming majority of cases, you can only have one FHA loan at a time. You could probably have a VA loan, maybe even 2, depending on if you use up your full benefit. If you were a veteran, military veteran, thank you for your service. And you could have an FHA in addition to that, but not likely. That this is like those things that are not likely to do. Susan before was saying, hey, it doesn't sound right about the vacancy. I happen to know that that's the reality, but the reality is it's really hard to do the multifamilies repeatedly. That's a reality. The vacancy one, it's totally easy to do. Okay. Gian says, numbers include her stock portfolio, which is not displayed. Oh, yeah. Let's go look at her stock portfolio. We can look up any numbers. That's what's great about this is like, this is not a fixed presentation where I don't have the data. I could show you what her stock portfolio is. So let's take a look at her account balance. So her account balance, it shows you that. Let's zoom in. So she started off with this 100K. I'm going to zoom in even more. Started off with this like $100,000. She bought a house, so she's down to that $84,000. Her stock market portfolio is increasing until she has that down payment for the second property. Stock market's going up and down. Down payment for the next one, up and down. Stock market for the down payment for the next one. And so, like, what did we say it was? What month did she retire? I don't even remember now. Anyone remember what month she retired? I can just look it up, I guess. Month 211. So month 211, so let's take a look at 211. By the time she's ready to retire in month 211, her stock market account balance is about $700K. Because she's got the cash flow from the properties, she's just accumulating in there. Now, in another alternate reality, we could go and look at, should she take this money and pay off some of the houses, right? We could totally do that. But her account balance really isn't starting to grow until after she's acquired her last property right here. Okay. So GN also asks, were these done with 30-year loans? Yep, they totally were. So let's take a look at that because we can. So let's look at mortgage balances. So these were all 30-year loans. This is how much each property owed. Each mortgage balance on the property. So the first property she got in month 1, it was a mortgage balance of $237,500, and she paid it off over time. Basically, in month 360, she's done. And the second one, she got this mortgage right about here. She paid that one off over time 360 months later. The third one, the fourth one, the fifth one, the sixth one, the seventh, the eighth, the ninth. So she basically did this 9 times the last property she's living in, 8 of them were converted to rentals. Okay. Ann says, can you please clarify the all-in-one account? Yeah. So, Ann, what I could have done, in theory, is I could have said, Andrea's smart. She's not going to keep 100% of her money in the stock market. She's going to have a savings account that's got, $5,000 in it for like her living expenses, and where she deposits her paycheck and she pays her credit card and she does all that stuff from. Okay. And she probably, if she's smart, is probably going to have a reserve account somewhere else that has her money for like property maintenance and where the lease payments go into and the mortgage payments come out of. And so she probably would have a separate account, or maybe several accounts depending on how she structures her asset protection. So she probably in reality has like multiple bank accounts. But rather than me confusing the story and making it more convoluted and saying, well, she's got $5K here and she's got $25K here and she's got, $600K in this account, rather than do all that, I just said, I'm going to dump it all into one all-in-one bank account to make the math and the storytelling easier for you. But in reality, she's probably going to have multiple bank accounts. So does that kind of answer your question about why that's set up that way? We could do it that way. We could model it. It makes it much more complicated because you got to move money between accounts. And what happens if this account runs out of money? What do you do? Does the account go negative? Do you pull it? Where do you pull it from? How much do you pull? And sort of that stuff. So that's why we do it that way. Yeah. So Ann says, yeah, that's perfect. So it shows the mortgage balance there. It shows it being paid off. And this, the mortgage balance being paid off, that's part of the debt pay down, right? That part of that return that we saw when we're doing that. Okay. So that's really Andrea's story. She is able to go from recently divorced, 2 small kids, 2 and 4, 2 boys, which she loves, and she's concerned about their future. And she wants to be able to spend all of her income, to invest all of the resources she has from her job into providing for her kids and giving them the childhood and their adolescence that they deserve and help them. And now she's able to do that by taking this nest egg she got from her divorce and investing that over time. And I'm not sure, she felt as though, with the advice of her friends, that she should not do anything rash immediately after getting divorced. She needs some time to kind of like take a breath, make sure everything gets back to a new normal for the kids, for her, everything else. And so she doesn't want to go and take $100,000 and dump it into something she's never done before. This allows her to buy one property to live in. She was going to do that anyway. She's used to living in a house. I can buy a house to live in. That's not a big change. Do that. She's got a year to breathe before she figures this stuff out, decides what she wants to do. She decides to take the step and do one rental property, converts the one she was living into a rental, moves into another house. Takes a breather, figures it all out, makes sure everything gets back to equilibrium, status quo, helps the kids, focuses on the kids, makes sure she's there, makes sure she's a great mom, provides for the kids, do the next one. And she's got big reserves. She had this full $100,000 reserve account. She took some of it, small amount, $15K, invested in the down payment. She got big reserves, does another one, $15K, still has big reserves. Paula says, so maybe I'm dense, but I don't understand how what you have just described addresses this. How to acquire 8 rental properties with down payments for 2. All props had down payments, right? What am I missing? So let's take a look at this. Andrea started off with $100,000. Which is 2 down payments for rental properties. She basically said, I could go buy $250,000 properties with $50,000 down each, 20%. 20% of $250,000 is $50K. So she has down payments for 2. Now what she's able to do, instead of actually doing down payments for the 2 properties, she decides, I'm going to buy 1 property a year for 9 years. At the end of that, she has 8 rental properties using the same down payments she originally had for the 2. And she now has 8 rentals. Okay? So it's just it's a restructuring of how you deploy your assets, in this case, for Andrea. And in her case, it makes a lot of emotional sense. Sometimes we talk about the logic, the like hardcore math of optimizing return. Do what's going to get you the biggest, best return. In this case, I don't think that's what's best for Andrea. But it's up to her. She gets to decide. But she did decide in this hypothetical situation. She decided, I'm going to take it slow. I want to make sure my kids are taken care of. I want to make sure I'm not doing anything rash. Think this through. Get advice over time. Take the time to do it. Okay? Apollo says, I get it now. Yep. GN says, I'd be interested in seeing the math for house hacking in a higher price market. Yeah, absolutely. So if you guys like this format, like storytelling format of this is Andrea, this is her situation, this is what she's thinking, this is how she's like looking at stuff and kind of evaluating it, and this is what she ended up doing, and we can look at any of the math. And so you'll notice I wore a short sleeve shirt today. There's nothing up my sleeves. If you want to see any of the data, let's go take a look at chart. I have charts for everything. You want charts for any of the metrics, any variable you could possibly measure, I got it. So if you want to like look at that, whatever you want to see. And GN, yeah, sure, we can do math for any scenario. We could find a person who's living in a more expensive market and they decide to house hack, and let's see what the math looks like for them. They may need more reserves to fund some negative cash flow, to kind of do that, but that's the case. Yeah, we're not doing it right now. In case you're like, let's do it right now. Yeah, I got stuff to do today. I got to work. Okay. So I hope you guys enjoyed story time. If you have any final questions, I'll leave it on for like a minute or so. But thank you all for joining me. If you did like these, please drop me an email. Let me know if you want to see more, because right now I've got them kind of scheduled each week where we'll tell a different story. We'll pick a different person. Mike says loves the new format, so I appreciate that. Yeah, so if you think the story format works well for you, kind of just picking someone's situation and going deep on just one narrative, then I'll try to do more of those. And Lynn says, this was great. Really like this format. So, yeah, we'll go ahead and probably do some more of these until I get tired of doing them. But I hope you guys like them. I enjoy the story format. I think it's good to kind of do it. And you do get taught, right? You do get the information you need about different loan programs and how that works and how depreciation works and how we think about things and that stuff. So, yeah, Jillian says story format is great. Okay, awesome. So that's the feedback we're getting. I appreciate it. I didn't know if it would go this long. I thought it might be a 30-minute thing, but looks like it is about an hour. So, well, if there's no other questions, oh, wait, we do have a question. Brittany says, may I ask, when converting properties into rentals, does that just mean to rent the houses or literally convert them into separate properties? That's a really good point of clarification, Brittany. In this case, we are literally taking the exact same house she lived in, and she's going to put tenants in there. Okay, so it is not converting it and by buying a different house. It's the house that she was living in. She needs to pick a house that would make a good rental. And if you think about it, her alternative was to go rent the property. So she's going to go pick a house, and she's like, this would be a good 3-bedroom, 2-bath type home for a rental. I'm going to go buy the same property. And then when I move out of it, I'm going to convert it into a rental to do that. So yeah, it's literally the exact same house. Ann says, thanks so much. I'd love to hear a more personal side of this from your experience. How do you move every year and stay sane? Oh, boy. Yeah, that is tricky. So not all the stories are going to be Nomad, right? Nomad is it's a strategy. It's a great strategy. I mean, the returns on it are like probably the best, right? Plus, I assume you're doing some work on the house. No, that's a really good point, Ann. In our model here, she is buying pretty houses where the houses are completely done. There's no like fixer upper stuff. She's not trying to buy a property undervalued like a burr and add some value to it by doing some handyman work or anything like that. She's buying pretty houses, move in ready. Everything is done. And as you can see from the math, it doesn't really matter that much because honestly, the cash flow for her retirement doesn't come from equity. We could go and sell properties. We can go look at like what's the amount of equity she'd walk away with if she sold these and converted it to stocks and just decided to live off 4% safe withdrawal rate from stocks. We could look at that as an alternative. But really, in this model, where is the money she's getting to live on when she retires? It's coming from cash flow and a little bit from the stock market money. It's not coming from the equity in the properties. The equity itself is not providing income. So no, you're not doing any work on the house in this case. But the point about how you stay sane with Nomad, valid point. Totally valid point. And for some people, it's easy. They don't care, right? And for other people, it's really hard. Like for me, it's tricky. Like I get stressed out. So definitely a concern. The alternative is you save up 20% or 25% down and you don't move in. Or you nomad by proxy and have your kids nomad for you, or your parents nomad for you, or something like that, and you are involved in a transaction. We could do a whole story about that. We probably should. So Candace says, I like the story format and the schedule. Thank you. Yeah, you're very welcome for that too. And Brittany says, great. Thank you very much. Yeah, so I think I covered all the questions we have, but if we have any more, hopefully we'll have other ones. But thanks again for everyone for joining me. I'm glad you guys like the format. And yeah, Ann says, yes, please, on the proxy story. Yeah, we probably should do a proxy one. Yeah, I agree. I think that's a really good one. Yeah, we're discussing proxying with my son. He's 20. He's going to be 22 this week. And so we're going to do some type of special arrangement. We're going to offer it to him. We'll see if he takes it on or not. We'll offer him a special arrangement where he can live rent-free for the first year in exchange for being the nomad. So basically, he'll be able to live there. He'll get some roommates, so there'll be some income coming in the property, but he will not have to pay rent in exchange for him living there for the year. And it'll be like a kiddie condo loan, which I'll go into a ton of detail. So everyone else can ignore that for now. All right, guys. Thank you very much for coming on. I do appreciate it. I'm going to end the recording now. I will not stick around for recording after the fact, so I'll just end the entire webinar. But I do appreciate everyone for sticking around, and I hope you enjoyed the story. Thank you all for coming. I will talk to you soon. Bye-bye for now.